If governments flipped this one switch tomorrow morning, the economy would go quiet. Not crash, not explode, just quiet. Credit would tighten, asset prices would wobble, growth would slow. Politicians would rush to microphones and use words like temporary adjustment. And within months, voters would feel it in their jobs, their mortgages, their retirement accounts. So the switch stays on. Almost always. The switch is cheap money. More specifically, the constant expansion of liquidity through low interest rates, deficit spending, and central bank support. Governments fear turning it off, because modern economies are no longer built on savings first and growth second. They are built on debt first and stability second. And once you understand that, you start to see why this switch can't be flipped without consequences. Right now, global debt sits at over $300 trillion. That's more than 3 times global GDP. Governments owe, corporations owe, households owe. Entire systems run on borrowed time. Debt isn't inherently bad. It can fund innovation, infrastructure, homes, businesses. But debt has a condition. It needs growth. Specifically, it needs growth that outpaces interest costs. That's where the switch comes in. When interest rates are low, debt feels manageable. Governments can refinance old debt cheaply. Corporations can roll over bonds. Homeowners can handle mortgages. Investors borrow to buy assets. Everything moves. But when rates rise, even slightly, the math changes fast. Imagine a government with trillions in outstanding bonds. If average borrowing costs rise by just 1 percentage point, interest payments can jump by tens of billions annually. That money must come from somewhere. Higher taxes, spending cuts, more borrowing. It becomes circular. This is why cheap money isn't just stimulus. It's support. Let's walk through how the switch works. Central banks set benchmark interest rates. When rates are low, borrowing becomes attractive. Banks lend more. Businesses expand. Consumers spend. Asset prices rise because future earnings are discounted at lower rates. Lower rates inflate the present value of almost everything. Stocks look more valuable. Real estate looks more affordable. Risk looks tolerable. Then there's quantitative easing. When central banks buy government bonds and financial assets, they inject liquidity directly into the system. That pushes bond prices up and yields down. It encourages investors to move into riskier assets. It's subtle. No one receives a check labeled asset inflation. But balance sheets expand. Governments benefit too. When central banks buy government debt, borrowing costs remain suppressed. Fiscal deficits feel less urgent. Spending programs expand. Crises get funded. In emergencies, this flexibility prevents collapse. During the 2008 financial crisis, central banks slashed rates to near zero and began massive asset purchases. During the pandemic, they went further, injecting trillions into financial systems almost overnight. Markets stabilized quickly. Asset prices rebounded even while unemployment surged. That contrast tells you something. The switch doesn't operate evenly. It stabilizes the system from the top down. Now imagine turning it off. Interest rates stay high for an extended period. Asset purchases stop. Liquidity tightens. Highly leveraged companies struggle to refinance. Zombie firms, businesses that survive only because debt is cheap, start failing. Housing markets cool sharply as mortgage rates rise. Governments face higher interest costs. Budget deficits widen without new spending. Investors reprice risk. Markets don't like repricing. They prefer predictability. Here's the uncomfortable math. Modern financial systems are structured around the assumption that liquidity will return when stress appears. This creates what economists call moral hazard, though the phrase sounds cleaner than the reality. If markets expect rescue, they take more risk. If governments fear downturns, they stimulate faster. Over time, each cycle requires more intervention to achieve the same stabilizing effect. It's like caffeine. The first cup works. The fifth cup barely moves the needle, and withdrawing completely produces headaches. Now contrast this with the popular narrative. The narrative says governments fight inflation by raising rates decisively and keeping them high until price pressures fade. Sometimes they do, but there's always tension. High rates fight inflation. They also fight growth. They pressure debt-heavy sectors. They expose structural weaknesses. Politically, that's dangerous. Voters feel rising unemployment faster than they appreciate long-term price stability. Asset holders react loudly to falling markets. So policymakers walk a narrow path. Tighten enough to appear responsible. Loosen enough to avoid pain. The switch flickers, never fully off. Let's zoom in on government debt specifically. When a country runs deficits year after year, debt accumulates. As long as nominal GDP grows faster than the interest rate on that debt, the burden feels sustainable. This dynamic is crucial. If growth is 5% and interest costs average 3%, the debt-to-GDP ratio can stabilize or even decline. But if growth slows while interest costs rise, the ratio worsens quickly. This is why low rates are so powerful. They tilt the equation. They make large debt loads look manageable. Turning the switch off removes that tilt. And in a world where entitlement spending, defense budgets, infrastructure projects, and social programs are politically entrenched, sharp austerity is rarely popular. So instead of turning off cheap money entirely, governments often prefer gradual adjustments, forward guidance, carefully worded speeches, incremental rate changes, enough to signal discipline, not enough to trigger panic. Meanwhile, markets adapt. Corporations refinance before maturities. Investors hunt yield in new places. Financial engineering evolves. The system stretches but does not snap. There's another layer. Cheap money doesn't just support debt. It supports asset valuations. Pension funds rely on certain return assumptions. Insurance companies depend on stable bond markets. Retirement accounts are heavily tied to equities. A prolonged market decline threatens not just portfolios but social stability. When asset prices fall significantly, consumer confidence drops. Spending slows. Layoffs follow. Tax revenues shrink. Governments then face pressure to respond. The switch clicks back on. Even when inflation surges, policymakers face a dilemma. Keep rates high and risk recession, or ease policy and risk persistent inflation. There is no painless option, but the path of least immediate pain often wins. History offers examples. In the 1970s, inflation soared in many advanced economies. Central banks initially hesitated to tighten aggressively. When they finally did, recessions followed. In the early 1980s, the U.S. Federal Reserve raised rates dramatically to break inflation. The short-term cost was severe unemployment and economic contraction. It worked, but it was politically brutal. Today, debt levels are far higher relative to GDP than in that era, which makes aggressive tightening more complex. The higher the debt, the more sensitive the system becomes to rates. That sensitivity creates fear, not conspiracy-level fear, structural fear, the fear of cascading defaults, the fear of frozen credit markets, the fear of pension instability. So the switch remains within reach, ready to be adjusted, rarely fully turned off. Now zoom out globally. Reserve currency nations, especially those whose currencies dominate trade and finance, have more room to keep the switch on. They can issue debt in their own currency. Demand for that currency remains high. Other nations don't have that luxury. If they expand too aggressively, their currencies can weaken sharply. Inflation can spiral. Capital can flee. For them, the switch is harder to control. This creates a hierarchy in the global system. Some can sustain cheap money longer. Others must endure sharper adjustments. Back at home, the long-term consequence of keeping the switch on is subtle. It distorts incentives. Companies prioritize financial engineering over productive investment. Investors chase momentum. Asset prices inflate beyond fundamentals. Wealth inequality can widen because asset owners benefit first from liquidity expansion. At the same time, the system becomes dependent on intervention. Markets price in future support before it happens, which makes withdrawing support even harder. It's a feedback loop. Cheap money encourages leverage. Leverage increases fragility. Fragility increases the likelihood of intervention. Intervention reinforces expectations. And so it continues. So what would it actually mean to turn the switch off? It would mean tolerating deeper recessions, allowing more failures, accepting lower asset prices, reducing fiscal deficits aggressively, letting inefficient firms dissipate. In theory, that could reset imbalances. In practice, it would be painful. Painful in unemployment numbers, painful in political consequences, painful in social trust. And democracies are not designed to choose pain voluntarily when alternatives exist. So instead, the system manages cycles. Inflate, tighten, ease, repeat. Each time, the baseline level of debt edges higher. Each time, markets assume support will return, which makes the next tightening more delicate. The one financial switch governments fear turning off is not just low interest rates. It's the expectation of rescue. Once that expectation is embedded, removing it risks shock, but maintaining it risks dependency. And dependency can quietly shape the future. If markets believe support is permanent, risk-taking expands. If debt is always refinanceable, borrowing grows. If asset prices are assumed to recover, caution fades, until something tests the limits. The real question isn't whether governments can turn the switch off. It's whether they can afford to leave it on forever. Because a system that relies on constant liquidity support may look stable on the surface, but underneath, it may be accumulating vulnerabilities that only reveal themselves when options narrow. So we are left with a paradox. Turning off the switch risks immediate pain. Leaving it on risks long-term distortion. And every year that debt grows, the decision becomes harder. If this perspective challenged how you see economic stability, please like the video and share it with someone who still believes policy choices are simple. Because the most important financial decisions are often the ones no one wants to make. And someday, the switch may not respond as smoothly as everyone expects. And before we close this chapter, one small request. If this video helped you see the system a little more clearly, if it challenged something you thought you understood, or if it simply made you curious enough to question the headlines a bit more carefully, please take a second to like the video. It tells the algorithm that serious, thoughtful financial conversations still matter. And subscribe to the channel, because we are going to keep pulling back the curtain on the systems that quietly shape your money, your future, and the rules most people never realize they're playing under. Thank you for watching. I'll see you in the next one.